When I started investing 5 years ago, I thought I was doing everything right. I was watching the YouTube videos, I was picking my investments, and best of all, I was taking action. But what I was actually doing is making so many quiet mistakes that was costing me so much money. Not obvious mistakes, the kind that beginners wouldn't even realize they're making. So in today's video, if I could start from scratch, here are the 5 mistakes I would completely avoid if I could start all over again. Mistake number 1, choosing the wrong account to invest with. I mean, at the time I was 18, I didn't even realize there was a tax efficient way to invest your money. I literally just found an app that I could invest with and just chose that one. To me at the time, it didn't even cross my mind to check the internet to see if there was a more tax efficient way to invest to potentially save any money. But then when I started reading heavily into investing when I was around 20 years old, I realized I was making one of the biggest mistakes I could ever make, and that was using a general investment account instead of a stocks and shares ISA. First of all, with a GIA, you only get £3,000 worth of tax-free gains that you can make from your investments before you have to start paying tax. Whereas with a stocks and shares ISA in the UK, you can invest up to £20,000 every tax year completely tax-free without paying any tax on your capital gains, your dividends, or your interest. I'm not saying a GIA is always the wrong way to invest your money, but especially if you're a beginner, the most probable outcome is a stocks and shares ISA is the most tax efficient way, apart from a pension, to invest your money. Once I fixed this, I did feel like a bit of a doofus. I'd been chasing hype stocks in the wrong accounts for so many years without realizing a stocks and shares ISA was even available. And that leads us nicely onto mistake number 2, chasing hype stocks. I think during 2020 was really the starting point of where people started to look at investing as a way to potentially grow their money over the long term. But I definitely felt during those times that that became an issue. You had people on Twitter saying you need to buy this stock, or you had people on Reddit saying you need to buy this meme coin. The same happened over on YouTube. You have people saying what you need to buy and not actually considering what is right for you, what is your risk tolerance, what is actually your investing strategy. Instead, you follow the advice of these people saying this is the next big winner, this is the next big stock, you need to invest in this, this is the hype, this is what you need to jump on right now to make all the money in the world. And social media obviously amplifies that. If you're seeing that over Instagram, TikTok, Facebook, YouTube, all of these different platforms, you're probably going to consider it. But one thing I have definitely learned is if you listen to people on YouTube or people on Twitter or all of these headlines telling you what stock to buy, it's probably already pumped to the price where it becomes unbuyable because so many people have bought it. Meaning it's become overpriced and the hype has already died down and no one is buying it anymore. I think the real problem is when you start to hear people talking about the same stock. If you hear your grandma talking about gold, it's probably not the right time to buy. And I definitely fell into this trap as well. What did I do? I put all of my money into Tesla when everyone was talking about it. Now, if I'd have left that money in Tesla, it would probably have done very well by now. But unfortunately, I wasn't a seasoned enough investor to see that there was a massive risk in individual stocks. And as soon as I seen it go down, I saw that as my chance to sell. That is why I think financial literacy, understanding the stock market, how it works, why you're investing, what is your investing strategy is so much more important than just jumping into a stock that you think is going to do well. Ultimately, you never know what is going to happen with an individual company, especially. You can read the financial reports, you can do all the research you like, but you're not an insider and you're not the unpredictable planet that we live on. So overall, hype is not a metric you should be investing by. Instead, you should be looking at making logical decisions, not emotional decisions. Investing should be as boring as watching paint dry on a wall. And with that, we move on to point 3, which is ignoring platform fees. Now that you've got a stocks and shares ISA, you probably feel on top of the world. You've got the account that is tax efficient, but how do you know that's the right type of stocks and shares Shares ISA. Unfortunately, just like the general investment account, the same goes with your Stocks and Shares ISA. There are better ones and there are worse ones. And fees are typically one of the biggest things that are ignored by beginner investors, including myself. When I started investing, I started with Hargreaves Lansdown. Now, of course, they're a great, reputable company. They're massive. They're probably the biggest in the UK, but they have some of the highest platform fees out there. And this is something, as a beginner, I didn't even think to look at. So I'm so glad I'm making this video right now, because this is what my 18-year-old self needed to hear. And I'm not just picking on Hargreaves Lansdown here, but I will use them as an example. They charge a 0.45% management fee just to use their platform. So that means from the returns you make from your Stocks and Shares ISA, they are going to be taking a 0.45% fee from your returns. And while 0.45% might not sound like a lot on paper, if you actually do the maths, if you were to invest £200 every single year for 40 years at an 8% return, you would end up with £688,000. But oh wait, you've got the 0.45% platform fee on top of that, and that will strip away £75,000 of your own money just on fees. That's why I always consider using a commission-free platform, because more of your returns stay with you and not the platform. Of course, fees aren't everything, but they play a massive part. Okay, now on to number 4, which is trying to time the market. Once again, I'm going to use Reddit and Twitter as an example, but the amount of people who tell you to buy low and sell high is getting quite exhausting. Their whole theory on paper sounds amazing. Obviously, you want to buy low and sell high to make the most amount of profit as you humanly can. But who are you and who am I to think that we know exactly when the market is going to crash and when the market is going to be doing well? For some reason, we think we can predict what is going to happen in the global economy. And once again, as I said before, we can't do that. So if you're waiting for the perfect time to invest, or you're holding cash because you think you know when a stock market crash is coming, or you're panic buying and selling because of short-term moves, you're doing it all wrong. I used to do this as well. I used to say to myself, I'll wait until the stock market drops a bit and then I'll invest. And then it goes up and I completely miss the timing. Unfortunately, whether you like it or not, most of us are not predictors of history. Time in the market beats timing the market. Consistency of investing. So if you invest £100 every single month, no matter if the market is up or down, that is so much better than trying to wait for the perfect time to put your money in. The best time to invest is typically when you just have money, not when it feels right to do so. Let me just show you this graph for an example. The cost of time in the market is clear. If you had £10,000 invested in the S&P 500 between January 2003 and December 2022, as you can see, if you were invested for all of those days, you would end up with £64,844. However, if you missed the best 10 days, it would only be £29,708. And if you missed the best 20 days, you would be on £17,826. And it just goes down and down the more you try to predict. Once again, this just proves that we're not superhuman. We are human. We can't make these predictions based on what we think is going to happen. We just have to try and invest when we can. And the last mistake, which I honestly think is probably one of the biggest mistakes you can make as a beginner investor, is letting the noise and news affect your investing decisions. How many times have you read the news and just felt absolutely depressed afterwards? Whether it's a recession, a crash, a war that's going on, we are fed all the negative information all the time over social media and mainstream media. And honestly, it makes you feel like you're not working hard enough, like you're not trying to keep up with what is going on in the world. But just 50 years ago, we didn't have a clue what was going on elsewhere in a different country, in a different economy. We didn't know this stuff. But now, because of social media and algorithms, they know that the negative stuff is going to be the stuff that actually gets people's attention. The latest example I can give to you of this is Donald Trump's tariffs last year. He basically just tried to put a tariff on anyone. And after a while, people settled down. They realized it's not as bad as it once was made out by the media, and then everyone goes back to their normal lives. It basically seems like every year the media try to grab something out of thin air to make a massive deal out of, when in the long term, that stuff doesn't really matter. The best example I can give to you to shut out the short-term noise is to look at the stock market history. Look at all the worldly events that have happened, the Great Depression, Brexit, COVID, all of these massive events, yet the stock market has continued to rise. We are fed all of this short-term news, which leads to recency bias, but if you just zoom out and look at the stock market performance as a whole, it always ends up going back up. So honestly, if your investing strategy changes because of the news, you never really had a strategy to begin with, and I would honestly say carry on your financial education and become more comfortable with investing and financially literate with investing before you even start. Honestly, that took me down memory lane. I made so many of them mistakes when I started, so I just hope this helps someone out there, hopefully an 18-year-old who is just about to start investing, not do exactly what I did. Investing at its core is actually very simple. It isn't easy to do, but it is simple. Don't overcomplicate it. I've literally just stole Higher Up Wellness's saying there, haven't I? Oh well, see you later.